it's Ben again. In this video, it's all going to get a lot more real. I'm going to show you what it's like when you start trading. The most important thing about trading is buying and selling the right currencies at the right time. How do you do that? The Velasco course is excellent for teaching you all you need to know. But in a nutshell, you stay up to date with the news and you learn to read the charts. Charts? Don't worry. I didn't know anything about them when I started trading, but it's easy, and I'll guide you through each step in the process. If you're wondering why bother at this point, check out the earlier videos which explain how Forex helped an ordinary guy like me become financially free. In the last video, I showed you how I earned £4,000 in a day by buying euro against the pound when the price of pounds versus euros changed from 1.25 to 1.24. We'll start with the candlestick chart. Let's stick with our example from the last video and talk about the difference in exchange rate of the pound versus the euro in a day. The great thing about these charts is that they change colour based on what's happening. So when the price of the pound against the euro has risen in a day, the candle is green. When it has dropped, the candle is red. The difference in the price at the start and the end of the day is shown by how big the candle is. So big drop in price during the day equals big red candle, while small increase in price equals short green candle. We can see the actual price change in numbers by the lines on the chart. It's simple, isn't it? However, quite a lot can happen in a day. So as well as showing us the starting and ending price, the candle can also show us what the maximum and minimum prices were across the day. See the wick on those candles? That's what they show us, hence the name candlestick. Candlesticks are most useful when you put a few days together. That's when you can start to spot patterns, and patterns mean opportunities. The price of one currency against another depends on the supply and demand of banks and companies exchanging those currencies. Some are selling and some are buying. If there are lots of sellers, the price of the pound against the euro will go down. If there are lots of buyers of euro with pounds, then the price of the pound against the euro will go up due to the high demand. But here's the thing. When buyers are buying, the price increases, so the buyers slow down because it's getting expensive. Meanwhile, the sellers are keen to sell to make a profit while the price is high. So they take over and then the price begins to go down. And then at some point the sellers will slow down because the price is low and the buyers will get busy again and the cycle repeats over and over again. Obviously, the most important thing to do is to buy low and sell high. The goal is to buy at the point where sellers slow down and the price is at its lowest, and sell once the buyers cause the price to go up again. Easy. And now for some lingo. In trading, buyers are called bulls and sellers are bears. Prices swing back and forth, but those candles show us the trends that enable us to spot patterns. If you can see that the pound has been going up against the euro, you know it's likely to slow down and then drop. Here's the chart from the example in my previous video when the price of the pound started the day at 1.25. Then the euro strengthened and the pound dropped to 1.24. If you look at the days before I made my £4,000, there are a number of green candles, which shows the price was rising. The bulls were buying hard. Then the day before my big win, there was a red candle, which means the price dropped. The fact that this red candle was bigger than the previous two green candles is a very good sign that the price was going to continue to drop, and that I should sell. Over the course of the day, I could see I was right. And when the price on the chart dropped from 1.25 to 1.24, I closed my position, which is the trading term for swapping my money back to the original currency. Okay, technical term coming up. This pattern is called an engulfing pattern because the first red candle's body is bigger than the previous two green candles. When you see this pattern, you know the sellers, or bears, have taken control. A bearish engulfing pattern means it's time to sell. Similarly, if you see a big green candle bigger than the previous one after 2 or 3 days of red candles, that's a bullish engulfing pattern and you should buy. Now you know about candlesticks, charts, and bears and bulls, head over to the Velasco trading site to get started with a free demo account. Or watch the next video to learn more patterns which will help you make money trading.